Selling weekly options pays you 52 times a year. Selling monthly options only pays you 12. That is the exact income strategy mistake that we're gonna fix in the next few minutes. And by the end, you'll never sell a monthly put again. And stick with me all the way to the end because I'm gonna show you a side-by-side example using a weekly option versus a monthly option, same ticker, same strategy, and you can be the judge on who wins. Welcome back to the channel. I'm Michelle with Cressivo. This is where we talk all about creating weekly income, selling options. Today we're gonna analyze one simple question. Why weekly? 3 reasons: lifestyle, capital efficiency, and uncertainty. I'm gonna walk through each one and then show you the math. Let's start with reason number 1 because it's usually the one that nobody talks about, but it's the one that actually changes your life. Weekly premium changes your lifestyle. Just think about the difference between getting paid every week or getting paid once a month. It's a fundamentally different cash flow rhythm. And once you start collecting those weekly checks, so many things become possible. You start using that money. You can pay bills with it and you can do fun stuff with it. When you start doing fun stuff with the income that you generate every week, it lets you fund your lifestyle. Also, weekly cash flow smooths out your emotions. When you're waiting a whole month for your position to expire, every up and down day feels enormous. But when you're opening and closing positions every week, you get into a rhythm. It becomes routine. The market goes down on Tuesday, who cares? Your position's gonna expire on Friday. And if it gets assigned, cool. You'll sell a covered call that Monday and take in income again. And if it expires worthless, cool. You just sell another put on Monday. That rhythm is worth so much more than people realize. It's the difference between a trader who feels in control and a trader who feels like they're always on a roller coaster. Reason number 2, weekly options ties up your capital for shorter periods of time. When you sell a cash secured put, you're locking up cash as collateral to buy those shares if the stock goes down. For example, if you sell a $50 put, you need $5,000 on the side to pay for the shares if you get assigned. That cash is committed. It can't go anywhere else. If you sell a monthly put, that $5,000 is committed for the entire month. So you see, a weekly option gives you 4 times the flexibility. And think about it. I don't know where the market's gonna go tomorrow or next week, let alone a month from now. I don't wanna lock up my money that long. Also, I wanna keep cash on the side to be ready to capitalize on new opportunities. If the market drops on a Wednesday and your favorite ticker is now on sale, you don't wanna be locked into another position for the rest of the month. You want your capital freed up in 2 or 3 days' time, so you can sell another put at a better strike. Shorter expirations means faster decisions, faster adjustments, and more chances to redeploy capital when the market hands you an opportunity. That's a compounding advantage that most people never quantify. Okay, now let's do the math. I'm gonna walk you through it step by step using the app that I use for my trades. Now this is just an example, but it's a perfect example to show you what the difference can be between a weekly option and a monthly one. All right, I'm gonna use NVDA as an example. I'm gonna type the ticker in here and I'm gonna fetch the data. And I'm gonna use an example of next Friday, July 31st, against 1 month out, August 7th. So let's start with July 31st first. And I'm gonna choose a mid-range contract. I'm gonna start with about a 20 delta. That means it has about a 20% likelihood that the stock is gonna drop from where it is now below the strike price before the contract expires. Now we often can't find the exact delta, so I'm gonna choose 19, like we can see here. So right now NVIDIA is 207.99. We can see the price right here. And this contract is a strike price of 197.50. Now this is paying 1.3, meaning $130 gets dropped into your account right when you make the trade. And if we annualize that figure out, we're literally making a little bit over 30% on our money per year. Now let's compare it to a monthly contract of the same delta. So we're going to choose August 7th, and we're going to compare it against this 20 delta, which is a 195 strike price. Now we can see that this contract is paying 206, so it's paying a little bit more money. However, you're locking up your money for 1 month instead of 1 week. So if we annualize our rate of return, we're only making a little bit over 25% instead of the 30% that we were making with the weekly contract. Now here's one of the few situations where a weekly option might not be the right choice. If you like a ticker that's been really beaten down lately and super low, it can be advantageous to go out further because everybody else is freaking out and generally the premium is a lot higher. And you know it's only a matter of time before that ticker turns around and you're totally okay waiting. Let me show you an example. Let's hop into my system. Okay, so I'm going to show you an example on Oracle. Now here's a 1-year chart, and it's been beaten up really bad, trading at about $120 per share right now. We're going to go kind of far out, and we're going to look at a January 2028 contract, about a year and a half away. Now, let's say I'm a big believer in Oracle because it has some great things going for it. First of all, it's very undervalued versus its peers, and a lot of analysts target the fair value price in the $250 range, and it's trading for half that much right now. Also, billionaire Larry Ellison owns about 40% of the company. So let's just see an example. If we were to sell a $120 put, right now that contract's trading for $34.75, as we can see here. That means that $3,475 gets dropped into your account right when you make the trade. You'd be committing $12,000 in capital because it's a $120 strike. And your annualized rate of return is just shy of 20%. If you want to check out the tools that I'm using in these videos, there's a link in the description. There's a 7-day free trial, so you can see if you like it. Now, Warren Buffett did a similar trade just like this during the financial crisis in the mid-2000s. He sold super long-dated 15 to 20 year S&P puts, and he collected about $4.9 billion. Now, you might not have the capital for that kind of a trade, but the strategy works for any size account. Now, there's a couple of other scenarios where weekly options might not be the best choice, so be sure to catch other videos here on this channel. Make sure you're subscribed so you don't miss any. Okay, quick recap. Weekly premium wins on 3 big fronts. It gives you a real income rhythm that you can live on. It ties up your capital for shorter windows of time so you stay flexible. And it turns the fundamental uncertainty of the market into your advantage instead of a threat. And when you run the annualized rate of return math, the same type of strike on the same ticker, you usually make more money annualized trading the weekly option over the monthly one. Use my tools to help you be a better trader. The link is in the description below. And if you're looking for one-on-one support, check out my mentorship program. That link is in there too. I only have a few spots open, and the cost is meant to pay for itself in multiples over time. That link is in the description too. All right, I hope you really liked the video. If you did, please smash the like button. Subscribe to the channel so more traders just like you find these great videos. Thanks for watching, happy trading, and I'll catch you in the next one.